Welcome to another presentation from SR Snodgrass as part of our ongoing podcast series. Today I'm speaking with Chuck Marston, our company's president. And with that, I have to also say you're one of the experts when it comes to the topic that we're talking about today, which is taxes in the state of Pennsylvania, specifically related to banks.
Well, thank you, Lenore. I'm very happy to be here. And yes, I've been doing this a long time. Over 25 years, I've been working with state of Pennsylvania financial institutions and their tax issues. So I am excited to talk about this, and I know there's been a lot of interest in the financial institution community.
I know that a lot of our clients are talking about this because, and specifically, the governor had recently released his 2025-2026 budget, and it deals a lot with bank taxes.
Yeah. There's usually always some type of tax proposals that are connected to the budget, the annual budget presentation. This year, there are some significant items that banks and thrifts in Pennsylvania really need to pay attention to. And really, there's three major ones.
So what are those three then? Let's get started with those.
Sure. The first is the reduction or the acceleration of the previously agreed upon reduction in what's known as the corporate net income tax, the CNI tax. The second would be the overall tax treatment of banks and thrifts as a whole. And then the third would be required combined reporting.
So let's jump right in. Let's talk about the Pennsylvania CNI, that corporate net income tax,
Yes.
right? So what can you tell me about the governor's proposal with his budget?
So the tax rate used to be 9.99%, one of the highest in the country. In fact, probably the second highest, the second highest. New Jersey's been first.
And that's for all corporations, right?
That is for most corporations. Okay. And several years ago, the governor, they agreed to a reduction schedule to bring that rate down to 4.99%. Basically, they were going to reduce it 0.5% per year for 10 years. Currently, we're at about 8.5%. This year's budget has a proposal to accelerate the reduction. Basically, instead of taking until 2031 to get to the 4.99%, this would accelerate it, and you'd get there 2 years earlier.
So you had mentioned that Pennsylvania's tax rate was the second highest. I'm curious as to how this proposal will make us more competitive then?
Yeah, absolutely. The average tax rate for, I think there's about 44 states that actually tax corporations on their net income. The average rate is 6.5, I believe. So as you can see, we used to be very high. Mm-hmm. This will put us right, when we get to the 4.9%, it'll put us right there with the other states.
Are all businesses in favor of this? I mean, it seems like a win-win
Sure.
for businesses then.
Oh, it is. It is for businesses, without a doubt, for two reasons. One, it brings the rate down. It reduces your taxes being paid. But two, anytime you have a scheduled decline in a rate or a tax over a certain number of years, there's always the chance that that's going to get frozen and stopped. And PA has seen that with many years ago, the capital stock tax. It's gone now, but it was being phased out, and there were several periods there where they just stopped the phase out. So this would be a good thing. Now, you had mentioned, or you had asked, who pays this tax. It is paid by almost all corporations in Pennsylvania. Who doesn't pay it are the PA banks and thrifts.
Does that get into the second point then?
Yes, which brings us to the second big item here. They are proposing, and it is important to keep in mind that these are all just proposals right now, but they are proposing to eliminate the taxes that the banks and thrifts currently pay and bring them into the CNI tax.
Sounds like that could be good. Is it always good? Is it
it's hard to tell. It's important to probably distinguish. They're two very different taxes. Forget the CNI. The two bank taxes are very different. The shares tax is a tax based on capital. It is it is put on banks with capital stock. So it's a very low rate. It's 0.95%, but as you can imagine, some banks are required to have quite a bit of capital. So it's quite a large tax. The mutual thrift tax is completely different. It is 11.5% of a thrift's book net income. Now this tax is on savings and loans, thrifts, savings banks with stock and without stock. So the two taxes are quite different. When you take a look at the shares tax and try to compare it to the CNI, it's tough. It's a totally different base. Instead of it being on income, it's on capital. And obviously the rates are very different. What I can say is the shares tax is a tax that tends to go up every year because a bank's capital typically will increase every year. Even in a bad year for a bank. For instance, a bank could lose money as far as their taxable income. They could have a tax loss due to an unusual year for charge-offs or things like that. That doesn't really impact the tax they pay to PA. They pay the shares tax, so it's based on capital. It is a very constant tax. As I said, it usually goes up. My guess would be, I obviously don't have access to all the PA bank's information, tax information, but we do many banks, as you know, in PA. And if I had to garner a guess, or my gut feeling would be that most banks would probably, over a time period of say 5 years or so, pay less tax under the CNI tax, especially when it goes down to 4.99% than they are currently. The thrift tax, a little easier to compare because they're both based on some type of income, and the rate, 11.5%, is extremely high. They probably, it would be the same thing. Some banks would lose, some banks would make out, but as a whole, just under that proposal would probably pay less than CNI. But there's a very big reason why banks and mainly thrifts may not want to go to CNI, which I'll talk about a little later.
I was just kind of going to lead into that because it sounds like it's a win-win for the thrifts almost. I mean, just at the rates, but maybe not.
It can be. Again, when you're comparing, it's really important not to look at any 1 year because you could make out 1 year and not make out the next. As a whole, I'd say the rate change itself, by itself, the banks and thrifts would probably be in favor of. But the third item to me is the big one.
So let's talk about that one.
Sure. The required combined reporting. Combined reporting is a term that's been used the last 20 years, usually this time of year when the budget comes out. Combined reporting would take away something that PA has that very few states still use, and that's what's known as separate company reporting. So, as an example, probably the best way to explain it, you have company A, and they own two other companies, B and C. And B and C might have intercompany transactions. In Pennsylvania, those three companies file completely separate returns. They're not combined. Like for federal, they would be consolidated into one return. And most states, they would be combined. But right now in Pennsylvania, they still file separate returns, which means if company B and C have a loan between each other and one company pays interest on that loan, well, one company has income in Pennsylvania and one company has a deductible expense in Pennsylvania. Under a combined manner of taxation, they'd both cancel each other out. So as long as all of the entities are in Pennsylvania, pretty much everything stays equal. But when you take, let's say you take C and put it in a state that doesn't tax interest income, now you can create an expense item that gets deducted in Pennsylvania for one company and doesn't have to pay tax on the income in the other. They call that the Delaware loophole. That's, a lot of people are familiar with that term. I don't like to call it that. It is really just a function of taking advantage of the rules that Pennsylvania still use, which are separate company reporting. Combined reporting would pretty much take that away. Combined reporting, you would, just like you probably are doing for federal in my example, take all three of those companies, eliminate any intercompany transactions, and they'd file one return in Pennsylvania.
So it sounds like that not only for businesses, but potentially banks as well, that could really negatively impact them.
Well, yeah. I mean, as I said, combined reporting has been floating around for a while. It would impact, the latest estimate is there's about 11% of the Pennsylvania businesses that would be impacted by combined reporting. And that just means those are the businesses that have subsidiaries, related entities in non-Pennsylvania states whose rules make them able to use their rules combined with our separate company rules to save on state taxes. So yeah, there would be a big impact. Now, when it comes to banks and thrifts, up until this, a couple weeks ago, really wasn't too concerned about combined reporting, because if they would go to it under the C&I tax, well, the banks and thrifts paid separate taxes. Now, as you can kind of see, that's kind of been taken into consideration here. And the budget proposal, at least, is saying, okay, we're going to bring banks and thrifts into the C&I tax, which would then bring them into the combined reporting if it goes. And yeah, there are many, many thrifts mainly, but very large banks as well, that probably have some setup that benefits them under the separate company reporting. It's also true that many banks there'd be no impact on it if they went to it. In fact, they might even be helped, because a lot of banks have holding company structures. And right now, under separate company reporting, the holding company files a C&I return in Pennsylvania by itself, and it usually has a tax loss, which isn't serving anyone any benefit. Under a combined, you'd be able to use those losses or expenses to offset the bank's income. So combined reporting is the tough one, I think, as far as the banking community and overall business community. Remember, combined reporting isn't a bank-specific rule. It's a C&I tax rule. And all the major companies paying C&I tax in PA, of them, there's going to be plenty that combined reporting would negatively affect.
So you had mentioned that they had been talking about combined reporting for years, that it comes up semi-frequently is what it sounds like. But we're not there yet, but it's talked about again. So that leads to the next question of what's going to get passed? What's going to happen? All three of them? None of them? Some of them?
I have no idea. Obviously, I don't know that for a fact what would happen. We're at the very beginning stages of this process. A few things I can give an educated opinion on. One, my opinion is none of these three get passed alone. Right now, PA still has a budget surplus, but they've been eating into it. And I think the projections are this might be the last year that they can use that. So in effect, it is not a very good time to be proposing tax changes that reduce the income that comes into the state. You take that along with the political climate and where things stand in Harrisburg, even doubly so. It would be hard to pass anything that has a net negative on the state's income. So my opinion is, obviously the reduction of the C&I rate would impact the revenues. I think that taking the banks into the C&I, especially under the lower rates, would probably also do the same as a whole. And the way you get there is you bring in combined reporting, which would bring money into the state. Now, I don't know if they offset completely or not, but because of the way things are, I really think the three are going to have to either all go in or
So you think it's all or not?
I think in those ways. Now, again, this is the very beginning of things. We could end up with something completely different. They have, over the last 20 years, passed rules and laws to try to combat the Delaware loophole, as they call it. And everyone knows it hasn't. It has just maybe put in other barriers, maybe reduced it. Combined reporting would really stop any significant benefits that we have with the separate company reporting. And one thing I can say for sure, very definite, these things don't usually go away. This is the first time that I know of that there's been a serious proposal to take the banks, their tax structure they have, and fold it into the C&I. If it doesn't get passed this time, I would not be shocked if it gets passed at some point in the future. And I think that's the only real definite thing I can say.
So what do you recommend that the banks consider doing right now then?
Well, I think I think a lot of them are doing it now. I've heard from many. I know the two Pennsylvania banking organizations are currently trying to gather as much information as they can from the state and from their members to try to determine what's best for the community as a whole, the banking community. As far as a bank is concerned, honestly, there's not a whole lot you can do but keep up on what's going on. You certainly can take your historical information and take it from the tax you paid and drop it into the PA CNI tax structure and see what your impact is.
But you said it can change from year to year too. So
yeah, the best thing I can say is I would not formulate an opinion based on a 1 year.
That makes sense.
I would look at 5, 10 years, just look at it and see how it might impact you. Because, I mean, the organizations are going to be looking to their member banks to tell them. And not every bank's going to have the same answer. So you really need to keep up on it. And I think a lot of banks are. This has been a big deal to them. And very early on, there's been a lot of activity looking at this.
So before we wrap up here, regarding the CNI tax, is there anything else that banks would be, kind of considering or would be for or against for that, other than just the amount of taxes they're paying?
Yeah, I do believe that there are a few. For one, there's a fairness aspect to this. Right now, we have 3 completely different tax structures, depending on whether you're a non-banking corporation, whether you're a bank with common stock, or whether you're a thrift under the mutual thrift tax. They're completely different. Now, it's really hard to say, well, which one's more fair, because they're different rates, different bases. But you can say that they're not treated the same. And what ends up happening, and we've seen it, I mentioned the C&I tax went down, or is going down quite a bit. Well, that was because there was a big push in PA to reduce the tax burden on Pennsylvania businesses. The banks and thrifts, they didn't benefit from that overall environment. They changed the C&I law and didn't touch the other two. And it's not just between banks and non-banks. The two bank tax, the shares tax and the thrift tax, they get treated differently. The shares tax it's been around since the Civil War, the concept of it, since the 1860s. It has undergone some changes recently that have benefited the banks. Mutual thrifts have not. This mutual thrift tax, it's been around since the early 60s, I believe. And in my 27 years or so, there's been no significant changes to it. So they even get treated differently. I think having all Pennsylvania businesses under one tax structure would be a benefit, regardless of how the taxes work out. Most states have already gone to this. Most states, there are a few states, but not as many as there used to be, that used to have just bank-specific taxes. Many of them are changing to put them all under one umbrella. I also think from an administrative standpoint, as I said, they're completely separate taxes with completely separate rules and laws, but they're all collected by the PA Department of Revenue. So it is very hard to get issues resolved with the PA Department of Revenue when you are talking about the shares tax and the thrift tax. Very hard. And one of the main reasons is you really got to get lucky and get someone familiar with those taxes, because many in the Department of Revenue have no interest or concept of these bank taxes. They don't deal with them. So that makes it tough. We've also seen it in ways of, PA tax credits. They're for certain years. Well, the shares tax, and the banks are heavy users of these credits. The shares tax is a tax based on January 1st. So the years are constantly getting mixed up in PA's system when it comes to those. So just the fact of having everyone treated the same and having one law, one set of rules for taxes. I mean, right now, just due dates. If you're a PA corporation, your returns are due March 15th or maybe April 15th or maybe May 15th, depending on whether you're a bank, a thrift, a corporation. It would certainly simplify things, and I think there's been a big push for that. So I do think there are things here that banks and thrifts can look at and say, well, if overall there's not much impact to me, there's a lot of possibly non-tax paid impact here that might benefit me.
That's really interesting to think of it from that standpoint. And it sounds like overall his proposal has a lot of impact on financial institutions as a whole.
Oh, it certainly can. Yeah. Now it may end up with none. Again, if you think about it, if all they do is accelerate the C&I rate reduction, banks really don't care. Or if all they do is pass combined reporting, but they don't bring the banks and thrifts under the C&I law, it won't impact them either. It is really all three together that if they do get passed, it will have a major impact on banks and thrifts in Pennsylvania. And right now, all you can really do is figure out what side you're on. And every bank's going to have a different answer. And they really have to look at their historical information and work with people like me to try to determine what's best for each bank.
And I think that brings us to a great closing point then. It's one of the things that you and your team are staying up to date on. So when people have questions, reach out. You're going to be up to date, providing information to clients on this and giving updates as we go through it. Oh,
yeah, absolutely. We're currently trying to look at the historical information and returns we have on all the banks and thrifts that we work on in Pennsylvania, just so we're ready with those answers as to, well, what would benefit this bank the most, and trying to get a feel from that. What is the overall benefit? I do think we probably have a long way to go. I mean, they have several months to work this out. It'll be interesting to see what happens. But yeah, we all of us in the banking community really have to keep an eye on this.
So as things continue to develop, we recommend all of our podcast viewers subscribe to our YouTube channel, as well as the newsletters that you and your team put out on a regular basis, especially when there's big topics like this. So thanks for coming back to the podcast and sharing all the information on how banks could be affected by this.
Thank you for having me.
At SR Snodgrass, we're always growing. We have offices in Pittsburgh, Philadelphia, Ohio, and West Virginia. Whether you're entry level, senior level, or somewhere in between, we invite you to check us out. Go to our website at www.srsnodgrass.com, follow us on LinkedIn, and join us on our quest for the best.